That's you.
Good morning, everyone, and good day wherever you may be joining from. Absolute welcome to our oil and gas, utilities, and mining webinar. This is one of the part of the series that we've been doing on the tax reform, and we've actually had the opportunity to do 4. So be sure to go to the website if you were not able to join those. One on the consumer, industrial, and industrial products industry. We've also had on the finance industry. We've touched on individuals as well, and also looked at how it affects non-residents. Today, we'll be doing the oil and gas, and my name is Chijioke. I'm a partner in PricewaterhouseCoopers, and I'm honored, absolutely honored, to be welcoming our tax and regulatory services leader, Chijioke Uwaegbute, who will be driving this session alongside Babatunde Olaniyi, our associate director. Fantastic experts in the industry. So be sure to ask your questions. Be sure to sit still during this 1-hour session. It's a lot to unpack. So I'd really encourage that you ask the questions as you go so that the panelists or the facilitators can pick up those questions very promptly. So over to you, Chijioke and Babatunde.
Yes, thank you very much, Esiri, for the beautiful welcome address. I'm Babatunde Olaniyi, and I'm Associate Director with PwC Nigeria. And I have over 12 years of experience doing this. I'll be your facilitator for today, right? And I have the greatest opportunity, right, to introduce my leader to facilitate and drive the session for this industry. Now, today we're looking at 3 major industries within the Nigerian economy that drive economic growth, employment. From a fiscal standpoint, monetary standpoint, these industries contribute nothing less than 10% of our GDP, right, and contribute not only to our government revenue, but also our foreign exchange reserves as well. By introduction, I am Babatunde Olaniyi again, right? I've been doing tax and regulatory services for 12 years. I've had experience with PwC in the UK, right? And in terms of my experience, I have experience in all the industries covered today: oil and gas, power, mining, and I've advised clients across different projects in those sectors. In terms of my professional qualification, I'm a BSc accounting holder from Covenant University, and I have degrees with the Chartered Accountants of Nigeria and also Taxation Institute, both in Nigeria and the UK. So as I said before, I have the privilege to introduce my Africa oil and gas leader and also power and mining leader as well. So I'll be presenting to you Chijioke Uwaegbute, who is a partner with PwC Nigeria and heads our tax and regulatory services unit. He also heads the firm's public sector unit as well. He has been doing this for over 26 years, over almost double my years of experience in tax. Previously, he was a regional executive, right, in GE with operations globally, right? So in terms of oil and gas, in terms of mining, in terms of power, right, is definitely the right person. He holds an accounting degree from the University of Nsukka, right? Also a chartered accountant and a chartered tax advisor in Nigeria. In terms of major oil and gas transactions in Nigeria, Chijioke has led landmark transactions. So at this point in time, I would hand over to Chijioke, right, to give us the presentation and insights for today. Chijioke, over to you.
Hey, yes, thank you, Babatunde, and good morning to everyone. It's really an honor and a pleasure to be here to engage on our Insight series on oil and gas, mining and power. Today, just a slight correction, I'm the Africa Oil and Gas Tax Leader, so that you don't get me into trouble with my bosses, right? But I mean, thank you for the very kind introduction. So we'll quickly just jump into why we're here and what we're looking to achieve in the next 50 minutes or so, right? So again, our agenda for today is essentially looking at an overview of the tax reforms, including the rationale for the tax reforms, and also the implications for the oil and gas, power and mining sectors. And then we'll just also try and provide some general guidance and insights of, and the general guidance and insights is really our view of the Nigerian tax laws, the changes that have come about and what we think players in this industry need to do to navigate and really prepare themselves for the changes that have come through. So quickly, while technology helps. Okay, that's fine. So again, the overview of the Tax Acts. So I think the first thing we should really talk about is the reforms and why the need for reforms. And obviously, if you look at Nigeria over the past, I don't know, since independence, I'd say that would be about 65 years. The question is, has our tax system really evolved to an extent where we can say as a country that we have a tax system that really is efficient, optimizes tax collections, is aligned to also global standards and global realities? And we found out that really Nigeria has really been behind in this instance. And you find that you also have significantly, underperforming revenue collection. If you think about our tax to GDP ratio, depending who you ask, but just somewhere around 10% versus what you'd consider to be, what is generally acceptable, globally, anywhere from 18 to 35%. So what we're looking at here is, can we then kind of look at our tax laws and how those tax laws can actually be revised to actually bring us to a point where we can actually say we are optimized from a tax revenue collection standpoint. There's better clarity for investors. There's also a level playing field where you don't create, an uneven, whether it's incentives or tax administration framework. So how have these tax acts been kind of structured? So there are 4 tax bills that have been signed into tax acts. The first is the Nigerian Tax Act, which for me is, just creates a better experience for us as tax practitioners and people who are actually just, given the responsibility for tax compliance, within our organizations or consultants like us, where you put everything into one document. I remember as a young tax practitioner where I'd have to think about, I have to go and look for the Value Added Tax Act. I need to go and look for the Companies Income Tax Act. Who has the latest version of the FIS Establishment Act? It just was, it just have too many things in different places. And being able to consolidate that into one document just gives you a bit more clarity around what you need to do. And also the fact that I remember in the past, the penalty, some of the different regimes you'd have one thing in one act and something different in another act speaking to the same issue. So this consolidation and bringing it together into one Nigerian Tax Act really for us was a step in the right direction. Now, and if you look at the Nigerian Revenue Service Establishment Act, again, moving away from, and I'm sure many people are going to have struggle with, you've always said FIRS, but now it's NRS. So if I ever say FIRS here, forgive me, I'll try and correct myself. So Nigerian Revenue Service Establishment Act, which creates, clarity around who should collect the tax, account for the tax, of the government of the federation. Now, we think it's a journey for the NRS, but we think it's a step in the right direction because you now have more efficiency in tax collection if you can then say the taxes, levies, and other payments due to the government will be collected by one organization, while other organizations can focus on the other things that they've really been set up for, right? So it then drives more transparency and accountability in tax collection and accounting for the taxes collected on behalf of the government of the federation. Then we talk about how do we administer this act, which is the Nigerian Tax Administration Act. For me, is just the icing on the cake. Because if you think about tax administration, how do you administer the acts? What are those different requirements under the different acts? But bringing everything together into one and then harmonizing it, what it then does is it creates efficiency in tax administration. And I'll give you an example. I remember under the old laws where you have a penalty regime of 5% under the PPTA, and then you have a 10% penalty regime in the FRS Establishment Act. And then you then start asking yourself, okay, can I make an argument? Obviously, the FRS Establishment Act then took some level of preeminence over the PPTA. But those kind of, disjointed issues are the things that are now fixed with the Nigerian Tax Administration Act, where you have everything clearly laid out in terms of how these taxes should be administered, what are the compliance requirements, what are the filing requirements, which for me is really great. Then the last one is the Joint Revenue Board Establishment Act. Again, really bringing us to a point of reality where we have people who we will now have a joint revenue board that actually has clear oversights on, the tax, how we need to kind of administer taxes, looking at different levels of taxation, whether it's at the federal level or the subnational level as well. Also talking to taxpayers' rights as well. I actually absolutely think that the tax ombuds is a step in the right direction because now we are able to now engage with an independent party that is able to kind of speak to some of our tax issues. I know many times as taxpayers, you would see the Federal Inland Revenue Service essentially acting out in a manner, or any other tax service that's acting out in a manner that seems to go beyond the powers that they have under the law. But having a tax ombuds, would actually help to protect taxpayers' rights and also help with dispute resolution. And obviously also the way they've reimagined the tax appeal tribunal as well, kind of then gives a bit more focus, whether it's at the regional level or with regards to even the people that are actually appointed to the tax appeal tribunal. So again, I'd say overall, great step in the right direction. It's a great first step. I know that as we kind of engage going forward, maybe some of the issues that we've seen that might come up in these ones, hopefully would have some level of clarity to be provided by the Nigerian Revenue Service and perhaps the Presidential Committee that also participated significantly in this reform or drove this reform as well. Some of the questions you might ask is when are these tax laws effective? And when will it be gazetted as well? These are things that hopefully we will get to know over the next few weeks as to the gazetting of the laws. But in terms of when it will start, in terms of its implementation, it will be from the 1st of January 2026. So we have effectively about just under 6 months to figure out what we need to do to get ready for the implementation of the law. Okay, so what are the implications for the oil and gas industry, mining, and power? And again, there are a few points we're going to cover, which is expanded definition of Nigerian companies, adoption of global minimum tax rules, taxation of income sourced from Nigeria, harmonization of income and capital gains tax rates, indirect sale of shares, and obviously the implications from a tax rates perspective, value-added tax rates, the input VAT claim and refund mechanism, consolidated incentives, and other compliance requirements. We're going to try and make this thing as practical as possible and also try and look at the implications. So the first one is what makes a Nigerian company a tax resident. So a Nigerian company, under the previous act, you'd just say once you're incorporated in Nigeria, you're a Nigerian company. But under the Nigerian Tax Act, it now expands the definition of a Nigerian company to include things like, one, if you're incorporated in Nigeria, obviously, which is what we had in the previous law. The second one is a central place of management and control. So the question is, what does that mean? Again, it's where are strategic decisions taken? For instance, your board meetings and the decisions taken by the board. Is the board sitting in Nigeria? If the board is sitting in Nigeria, it is then seen or be deemed to be a central place of management and control where strategic decisions are taken. Another one is the effective place of management and control. Where is the management and where are management and commercial decisions taken? Now, in my previous life in the industry, we used to have things like I would be working as perhaps the MD of a gas division, for instance, in, say, Ghana. But I'm reporting to the vice president gas operations in another country, right? Effectively, right, even though I'm the MD of that entity, the real decision making is taken by my boss, who would be the vice president of gas operations. And we have a lot of that in our industry, where although you're sitting as the MD of a company, you're really essentially like someone managing an operating unit, and you're reporting really to someone who is essentially running the business on your behalf. So again, these are things we need to start considering, because when we start looking at how we take our decisions, or like in terms of the way we're set up from a governance standpoint or from a management standpoint, we now need to start considering the implications, as it will now make us be considered a Nigerian company. Now, some of these implications we've talked about as well is, investment companies who earn dividend incomes may not be majorly impacted, because our assumption is that if you're considered a Nigerian company, even though the investment, the income you'd have earned is a dividend income, and then withholding tax would have been applied on that dividend income, and then that dividend income will be considered as franked. So if you're considered a Nigerian company, that income won't be subject to further tax unless you're looking to distribute it further. Then the other is we also do have entities in our industry that earn other forms of income. We could set up an entity, I don't know, in the Bahamas or in the BVI, and they are earning other income beyond investment or dividend income. Those entities will be impacted by this rule, because now if we have a central place of management of board decisions taken, strategic decisions taken in Nigeria, that income then suddenly becomes subject to Nigerian tax, and then you then have to start jumping through the hoops of compliance and all that in Nigeria. So the next point to touch on is minimum tax for qualifying Nigerian companies. Again, the law provides for a minimum effective tax rate, and it says where in any year of assessment the effective tax rate of a company is less than 15%, such companies shall recompute and pay an additional tax that makes the effective tax rate equal to 15%. And this new rate, applies again, the companies that would, have this minimum income tax applied to them would be companies that are part of a multinational enterprise group and companies with an average aggregate turnover of 20 billion and above. But if we kind of think about what I said in the previous slide about what could also make you become a Nigerian company. So if you have a foreign company that has a central place of management or control in Nigeria, suddenly you then fall into that space of minimum effective tax rate. And then also, companies that have enjoyed some kind of incentives, such as tax credits under the presidential executive order. So if you think about gas companies that have enjoyed the non-associated gas incentives where you get the tax credits, those kind of companies would also potentially fall into the requirement for a minimum effective tax rate. Now, the question is, what is a minimum effective tax rate and how do you determine it? Again, you determine it based off of what? The corporate tax paid over divided by your profits, right? Now, the question is, what does tax paid mean, right? Because if I'm looking to do an effective tax rate computation in a year, I would be thinking that it would be the tax I computed on for that year divided by my profits, right? But what the law speaks to is tax paid. And then if it's tax paid, I wouldn't have paid any tax by the time I'm computing my my income tax and trying to do an ETR computation for the year. So perhaps, this is one of the things we're hoping that the NRS could also provide some guidelines around what they mean here, because I would think the intent is that at the minimum, if you compute your tax for the year and divide that by your profits for the year, whatever effective tax rate you get should not be below 15%. This is a personal view. And again, we're hoping that there will be a better clarity there, because you can't use the tax paid, in this instance, it probably be tax paid in the previous year and use that to then compute your effective tax rate, because you're not really matching apples with apples. And then if it's in a year where either you did very well or you did very badly previously, then it would also create some kind of, wrong outcomes for you. And then the other one is, could this ETR potentially conflict with taxing provisions under Section 17 of the Nigerian Tax Act for non-residents based on a definition of a constituent entity or an MNE group? Again, we then say, if you look at a non-resident entity that has different requirements for taxation, of determining how much tax you need to pay, either looking at it from the profit margin of that entity applied to the Nigerian profits, or if you look at it from the perspective of also the amount of tax withheld, or the tax computed, or the 4% minimum tax where you don't have any, that income hasn't been subjected to withholding tax. The point we're making here is this: the definition of an MNE group includes a permanent establishment. So that means a permanent establishment could also be subject to this 15% minimum effective tax rate. And we hope that the NRS could also give us a clarification of what this really means, that will PEs also suffer this minimum effective tax rate? Okay. The next point would then be expanding the tax base beyond the Nigerian tax base beyond our borders. So we're then looking at controlled foreign company rules. So the Nigerian Tax Act imposes a tax on undistributed profits of foreign companies undistributed profits of foreign companies controlled by Nigerian companies. So for those of you asking questions, please just check the chat box. We do have someone that's responding to your questions. So while I'm speaking, your questions are being responded to in real time. So you can check the chat box for that. So the NTA imposes tax on undistributed profits of foreign companies controlled by Nigerian companies, where it is considered the foreign subsidiary would have distributed dividends without detriment to their business. So again, in this instance, we're saying that if I'm a Nigerian company, and if you look at the illustration we have here on the screen, where we say ABC Nigeria has a subsidiary in the British Virgin Islands, right? So what we're saying here is, if that subsidiary in the British Virgin Islands has not, distributed its dividends for a while, the Nigerian Tax Act would then, kick in. The provisions would kick in where the dividends will be deemed to be distributed. Again, to the extent where the foreign subsidiary the distribution does not have any negative impact on the business. I guess the question is, who determines what detrimental to the business means, right? And again, the other thing is, if I have that distribution, right, and then deemed distribution, and subsequently the company actually distributes the dividends and I bring it in through the government approved channels, which is the banks, right? That should actually be exempt from tax. So at this point, if you've already deemed that dividend to be distributed previously and included it in my income for the purpose of taxation in Nigeria, that means I potentially need to get a refund if I come back, subsequently to have that income distributed. So that's a question for the NRS to say, how would that work? And how quickly would I get my refunds for that deemed distribution? The second part of it is then that if I have a Nigerian company, right, who has a foreign subsidiary, and that foreign subsidiary, if I look at that, the effective tax rate of the foreign subsidiary, and it is less than the effective tax rate in Nigeria of 15%, then I would have to pay a top-up tax on the difference between the effective tax rate of the foreign subsidiary and the 15% prescribed in Nigeria. Again, the question I would ask is, so someone asked me to explain deemed distribution again. If I'm a company, if I'm a subsidiary, a foreign subsidiary of a Nigerian company, right? And I make profits and I have these retained earnings sitting there and I haven't distributed those retained earnings as dividends. What the law prescribes is that if you are a company controlled by a Nigerian company, those dividends could be deemed to be distributed, right? Those profits will be deemed to be distributed, right? And by deeming a distribution, that means that amount of profits will be added to my profits as a Nigerian company and subjected to tax in Nigeria. That is the deemed distribution. They would look at the undistributed profits and then take that amount as distributed and add it to the income of the Nigerian parent. And in doing that, what I've said is you've deemed a distribution when I have not made any distribution at all, and you've made that income taxable in Nigeria. If subsequently, say a year later, I decide that, oh, I want to pay dividends, right? When I pay that dividends from my from my offshore subsidiary, in this case, the British Virgin Islands foreign subsidiary, to the Nigerian parent, at that point, that dividend is not taxable in Nigeria because if you bring it in through the government approved channels like banks, it is considered as exempt from taxation. But remember that a deemed distribution was done in the past and added to my income and taxed. The question is, do I get a refund for that tax that I've paid on that deemed distribution? And then the second one is then that if the effective tax rate of the British Virgin Islands subsidiary is lower than 15%, then I would have to then, pay a top-up tax in Nigeria. I guess my question then is, if a British Virgin Islands is, has zero tax to pay, and you've done a deemed distribution, right? That deemed distribution, you tax it in Nigeria, and because BVI is perhaps a tax haven and has no tax to pay, its effective tax rate perhaps is zero. That means not only would that income be taxed in Nigeria as a deemed distribution, but you could potentially have a situation where you also have to do a top-up on that. So these are things that would also like the FIS to clarify so that we do not, have an instance of double taxation on the same income. Okay, let's move on. But you can see it's really interesting times in Nigeria for us. So the next one is the force of attraction rules as well. Again, the sale of goods of merchandise of the same or similar kind as those sold through a permanent establishment or made directly to Nigeria by a non-resident person or its connected persons. This looks at either services or goods, right? So if a non-resident entity has created a PE in Nigeria, right? What the law is now saying is, because we are trying to avoid a situation where we are looking to use our tax planning to actually avoid paying taxes in Nigeria. what they've said, what the law has provided is that Nigerian PE, right? If a Nigerian PE is providing services or goods to customer one in Nigeria, and those services and goods are the same services and goods that its parent company, I'm using parent company here, but I'm actually a Nigerian PE of the UAC entity, of UAE entity. If the UAE entity is also providing similar services or goods to another customer in Nigeria, then the income derived from that provision of services or goods to the Nigerian customer too by the UAE entity will also be attributed to the Nigerian PE. And to make matters more interesting, if ABC USA is also a connected entity that is also providing similar services or goods to the Nigerian customer too, that income and the profits is also attributed to the Nigerian PE. So we now have to be extremely careful around how we plan our contracting in the oil and gas industry, because a lot of us, especially in the service industry, the service part of the industry, we have these Nigerian PEs that we've set up because we are trying to manage the then requirements under CAMA if you want to do business in Nigeria, you have to set up some kind of Nigerian operation. That your Nigerian PE suddenly could create a situation where you then attract the profits of either the non-resident entity or a connected entity that is providing similar services in Nigeria. I guess the question is, what is similar? What is same? How do you define it, especially when you think about product and service differentiation? Again, these are some of the things we also should be pushing back to the NRS to say, how do you consider product differentiation or some kind of service differentiation as well? And how well do you even understand the industry to even determine what is similar, right? Again, these are kind of the considerations we have, right? So in this instance, it's the entire income that becomes liable to tax in Nigeria due to the force of attraction rules. Then the next one is then split contracts. And this is my favorite because this was my life for the longest time, split contracts. How do we determine, what is taxable in Nigeria or not? What this talks about here is this: non-resident companies who execute a project in Nigeria involving surveys, designs, deliveries, building, construction, assembly or installation, commissioning or decommissioning, or any supervisory activity in connection with these activities, irrespective of any splits or numbers of entities that perform the activities of the project, whether or not only part of the project was carried out in or outside Nigeria. So essentially, what this thing is, just to break it down simply, is what? The split contracts we typically had. And, in my 26 years of doing taxation, it's always been, let's split the contract, tripartite agreement. Let's ensure that the offshore supplies is kept in a separate contract, was clearly delineated, and the onshore installation and everything is clearly delineated. Here, what they're saying is those split contracts will not be applicable anymore, because once you have this kind of situation where you have a supply and potentially an installation and probably services in Nigeria, the entire contract will be subject to tax in Nigeria. So this is very critical because it then starts speaking to the business model, especially for the service companies, who would then start looking at the implications for them, costing of their contracts now, because there are additional tax considerations here. But, while we're just looking at this, we then asked ourselves, what about things like contracts where you'd have a lease and then you would have some kind of installation and some kind of services in Nigeria? Would that also come into this? Because again, this is very specific on the kind of projects in Nigeria. But because many of us in the oil and gas industry, we lease, whether it's rigs, barges, FPSOs, whatever it is that we actually, production, what do you call them? The mobile production units. Anything you're leasing into Nigeria, the question is, would that also be covered here, especially if you have significant profit margin on the lease side of things? You know, would we have that 10% withholding tax, or would it then say as a final tax, or would it then say that, look, that this split rules also apply to lease contracts as well? That's something we also need to clarify as an industry as well. And many of these things we're asking, just to be clear, we as PwC are also collating and we're compiling the feedback, you know, from the questions you've asked, our concerns as well, to communicate to the Nigerian Revenue Service and the Presidential Committee to say, please consider these things in whatever regulations or clarity that you bring to the law. Okay. And unfortunately, this is not moving again. So again, this is just an illustration to say that even though you have a split contract, the entire income is attributable to the Nigerian PE. I guess the question we'll then ask ourselves is, this is for a Nigerian PE. What if it's a Nigerian company that is set up and incorporated as a Nigerian company, which its profits ordinarily would be taxable? Would that also come into this split consideration here? Because we've been talking about a Nigerian PE all the while. But the question then is, if it's a Nigerian incorporated entity, would that also apply? And that's kind of what we also need to clarify. Okay, the next one is the 30% key consideration. I hope I'm doing well for time. 30% key consideration for transactions. Gains of a capital nature are now subject to tax at 30% following the harmonization of the CGT and CIT regimes. And this could also apply to companies who have an effective place of management or control. Okay, again, which means that you have now been defined as a Nigerian company, and we should always have that at the back of our minds. So again, the other thing to consider from a CGT standpoint is the indirect transfer of shares. So indirect transfer of ownership in a Nigerian company will be subject to tax in Nigeria if the sale results in a change in the ownership structure of a Nigerian company or a change in the ownership or interest in assets located in Nigeria. You know, this is very interesting for me because, you know, I've done many, you know, transactions where we've had, you know, global sale of shares and mergers, acquisitions, and the rest. And, you know, typically when I look at a step plan, you know, I remember one I did about 8 years ago. I looked at the step plan, and if you look at the Nigerian entity, and if you now start going through the ownership, right, you probably are maybe 15 or 20 levels, removed from Nigeria, if you're looking at where some of those sales are made. And what this says is that even if you're 15, 20, 30 levels above Nigeria, as long as it results in the change of an ownership structure of a company in Nigeria, right, then that means that the capital gains tax will apply on this. And so you now need to be extremely careful around some of these divestments that happen. Many times, you know, I've worked for a multinational and I'm sitting in Nigeria, there's some, you know, sale that is happening at the US level. The US is selling maybe a Dutch entity that is somehow linked to Nigeria. Many times in Nigeria, we don't get the information, we don't know. Or if we get to know, we're like, yeah, it has no impact for us in Nigeria. But now you now need to be sure that any sale that will create a change of ownership of an asset in Nigeria or shares in Nigeria or anything would be liable to CGT, and you need to have your Nigerian tax manager or your Nigerian tax controller in that conversation to also let you know what the tax implications are, or you can talk to PwC as well. Some questions have come up to say, well, some of these issues can also be managed through the requirements of the treaty, where in some treaties, you do have some of those treaty exemptions, but not every treaty would have an exemption for capital gains. So that's why my team was very cheeky when they tried to create a treaty shop here to say, will some of you now start going to shop for treaty countries where you can then start setting up to now manage the tax implications. But again, you don't have to start thinking about substance requirements and whether this will be seen as some kind of anti-avoidance scheme. Okay, another thing to consider here, and I think we mentioned it, is could the effective place of management now also bring you into the Nigerian tax net, where I'm saying that if I have XYZ Nigeria, who actually owns ABC, who actually has some kind of effective management in Nigeria over ABC Mauritius. So ABC Mauritius only becomes Nigerian tax resident, and then the CGT will then apply, again, depending on what the rules are with regards to the treaty and the rest. But that really could then become an issue as well. If you look at place of effective management and control and how it will then impact CGT. Okay? So let me quickly take stock because, you know, I'm having so much fun and I'm hoping, I was just wondering, as a tax leader, shouldn't I just extend this thing to 1 hour, 30 minutes? But again, stock taking and what we've learned so far. So with stock taking and what we've learned so far. So foreign companies can be deemed to be tax resident in Nigeria and taxed on their worldwide income at 30% if they are deemed to have effective control and management in Nigeria. The use of offshore vehicles need to be utilized with caution and due diligence, because you then not start seeing things around perhaps, the force of attraction rules, or whether, those looking at the profits of those entities as well, and whether there'll be top-up taxes in Nigeria and all that. The investment structures of multinationals also needs to be reviewed in this new tax era for tax optimization, because if you set up these entities offshore, now there are those controlled foreign company rules that will now kind of come into play. Start thinking about the income taxes that you need to pay, the minimum effective tax rates that will then kick in, the deemed distributions that will then come in as well. So you need to start carefully evaluating these structures in the past that seem to make sense. The adoption of the 15% minimum tax, it kind of impairs available incentives, especially if I'm thinking of myself as a gas company that's been able to enjoy those incentives under the presidential, initiative. And now it seems like even though I'm getting this gas tax credit, I'm now subject to this 15% minimum tax. So the question is really, where is the incentive for me to invest in non-associated gas? Exit strategies need to be evaluated for tax efficiency and compliance. What I need to tell you now is please go and look at all the investment decisions you've taken in the past year or 2 years, because I'm sure most of them, you've been looking at your exit strategy, and again, the implication for you is that now your exit strategy is no longer 10% CGT, it is now 30% CGT. And unless you're looking to exit, before the 1st of January 2026. So we need to just kind of think about that. Again, your supply chain contracting and structuring is key to creating value on major projects. So for major projects that we currently have, because again, remember, many of you are already sitting on these structures now with split contracts with your PEs. You need to now relook those contracts to see what the implications are. My concern is also that the cost of doing business in the industry could potentially go up, where maybe the end customer, maybe it's an oil major that is enjoying services from from service providers who are now potentially also layering all these taxes on top of it. So again, contract negotiations between for your service providers need to also be sure that you will not have some of these tax costs being shifted or being considered in the pricing. Okay. Next is value-added tax. I've been told that I've been told I'm running out of time, but I'll try and be a bit quicker. So input VAT claim, input VAT is now recoverable on all expenses directly incurred for taxable supplies, which will be fixed assets and services. And there's a 1-year limit for claiming, otherwise it's deemed to have lapsed. It may also be impracticable to deduct against output VAT deducted at source. I think this is absolutely a step in the right direction. So now, please stop shifting your VAT costs to your end users. I used back in the day, they would say, oh, look, we can't recover this VAT cost, and this VAT cost becomes part of our cost of doing business. But now you're able to recover it, or at least get a refund for it. So let us now look at it from the perspective of relooking our VAT processes to ensure that we have the ability to recover these costs, and we have the ability to claim the refunds in a timely manner. There's also been zero-rated goods now. Essentially, these are things in line with also just kind of alleviating the economic hardships in the country. You now have zero-rated some of these goods, basic food items, medical and pharmaceutical products, locally produced agri-chemicals, and the rest. And you can see that the whole idea is to also make these things more affordable. Because if you zero-rate the goods, that means I'm able to claim the input VAT on these goods, and there's no need to actually shift the cost of the non-recoverable input VAT into my pricing. And then e-invoicing and fiscalization, depending on which side of the divide you are, this could actually be really our North Star and the silver bullet that will actually crack compliance in Nigeria, where you now have a fiscalization where first of all, you need to probably classify your products and transactions for VAT, because again, you'll just be in a situation you have garbage in and garbage out, be able to maintain accurate and real-time records, digitize invoicing and receipts, and test and integrate with the FRS systems, and prepare for real-time reporting and audits. I think for me, this e-invoicing will make life so easy for us, especially when we're doing tax audits. Everything is now digitized. You have all the documents there. I don't need to send an associate to come and sit with you and start looking through your invoices and the rest, or your finance manager, your tax manager is having to dig through different ERPs for this. So right now, being able to digitize this and having a clear view on these things will actually give you a clear view of your tax costs and a clear view of your compliance, really, and then also give you a clear view of driving audits more efficiently and better reporting as well. Other incentives we have for power, refining, and mining, VAT exemption on renewable energy equipment, a suspension of the VAT on renewable energy equipment, and also an exemption from the 5% fossil fuels surcharge, right? There's also the tax incentive on the economic development tax incentive, which grants tax credits in place of a tax holiday, although it has some kind of transitional provisions for people that already have tax holidays. It provides a 5-year priority with 5-year extension, but the 5-year extension is also driven by if there's 100% reinvestment of profits into the similar priority sectors. And then also there's an additional incentive for pipeline investors who may get up to a 15-year tax incentive, which is inclusive of the maximum EDTI incentive. So that's an additional 5 years plus 10 years, which gives you an additional incentive of up to 15 years. But that 5 years period is a tax-free period. Now, we've seen different versions of the Act that speaks to how the EDTI will be computed. Some, a version speaks to computation based on the taxes for the tax computed, and another version speaks to computation based on capex investment, 5% of capex investment. But we believe clarity will come when the final law is gazetted. Okay, really out of time, but I'm gonna try to run. So again, key changes for FZE and EPZs. Please, just for those of you who are asking questions that I kind of run out of time, I know this is a very interesting topic that's going to raise a lot of issues. what we have done is we will, at the end of this session, respond to all the questions and send to everybody that participated. So you will get responses. Even if you don't get the response now, you will get a written response as long as the email address you use to register is what you use to receive your emails. Okay, so key changes, FZE and EPZ. Tax exemption applies only if 25% or less of the sales are to the customs territory. And if more than 25% of sales are to the customs territory, tax will apply on those sales. Essentially, what is happening here is the government is trying to create a level playing field. In the past, if I want to avoid taxes, all I need to do is just go and set up in a free trade zone, become an approved enterprise, and I'll just be selling it to the customs territory and not paying taxes. So what the law is looking to do is to kind of reduce the negative impact of that, because if I am in the same industry as you, I'm in the customs territory, you are in the free zone, and we're both selling to the same market. You are not paying taxes, I am paying taxes. You see that there's an imbalance here. So what the law is trying to do is to say, I'm going to give you a sunset period to fix your structure. So between the 1st of January 2026 and the 31st of December 2027, I will allow you to sell a percentage of your goods into the free trade zone, right? And sorry, into the customs territory, and I will only tax that portion. But from 1st of January 2028, all sales to the customs territory are taxable regardless of whatever percentage you sell. Again, reinforcement of the current rules that guide mandatory registration, filing of tax returns, and withholding tax as well. Again, that means these companies are required to comply with the tax filing returns, withholding of tax from payments as well. I think another thing that we should consider is effective minimum tax may apply to profits of a free zone entity, which is a member of an MN, a multinational group, or in respect of their sales to the customs territory. So again, remember that your effective minimum tax rate, would potentially apply if you're a free zone company. So next. So again, what we had said before, and I just saw a question that popped up, a bit distracting, but at least let me take that one. If you do have input VAT that you've paid and you don't have any output VAT, you can ask for a refund of the input VAT paid. Filing of estimated returns and monthly tax payments for midstream LNG. So that's new compliance requirements. Let's just kind of look at new compliance requirements that have come through. Filing of estimated tax returns, monthly tax returns, and filing of estimated tax returns and monthly tax payments for midstream LNG. Now, midstream LNG companies are expected to file monthly income tax estimates and make monthly payments, similar to their upstream, companies. But again, I think what we need to consider here is this. For me, I just think the government is looking to get its money upfront, because in the past it's been this dividend that they've been getting, but now we're saying that, hey, this is your taxes, we want to be seeing it upfront. So that's my view. Again, then there's a development levy, which is 4% of accessible profits, which replaces the ancillary. It replaces the different taxes that came through, on profits of Nigerian companies like Naseni, education tax. So in this instance, it just consolidates everything into a 4% as tax on accessible profits. But for those of you that still have things to play like NDDC or host community, this doesn't affect it, because this is an addition to that. Monthly royalty compliance for mining. Again, we think this is also with the fact that the Nigerian government is looking to set up a mining corporation similar to what we have in the oil and gas industry with NNPC Limited, which would hold the interests of the Nigerian government in mining, and also kind of drive compliance around the monthly royalties that you would get from such an endeavor. Then the other interesting one is royalties to be paid in cash. So discontinuance of in-kind payments of royalty. And we think it's just to enhance transparency and accountability, because also when you're paying in kind, there'll be all sorts of conversations around valuation of what was paid in kind. But if it's a cash payment, and I think that one is pretty clear in terms of its application. I have been told I'm out of time, so I'll just run through the last ones. Hydrocarbon tax on PSCs. Now, there's a 30% hydrocarbon tax may apply on converted PSCs in line with the petroleum industry tax. So again, you know, what it seems to suggest, if you look at the deletion section, is that, you know, it deletes the part that exempts the PSCs from the hydrocarbon tax, so they will pay a hydrocarbon tax. The limitation of capital allowance claim to PSC contractors, similar to that, it now says if we're looking to claim capital allowance on your hydrocarbon tax, you know, I mean, from a CIT standpoint, sorry, I take that back. From a CIT standpoint, it doesn't allow the claim of capital allowance for PSCs that have converted. And again, that is another thing we would like to kind of clarify, just to be sure whether it's an error, because again, you want to create a level playing field. If I'm a PSC and a company and I've converted, then I should be able to claim the capital allowance I have incurred on my company's income tax. Review of PSC, the Act has revised the period downwards from 15 years to 8 years. So going forward, and we think really it's, again, a way of aligning what the amendments to the Deep Offshore Act in 2019 in terms of the time frame of 15 years. If you look at what is left in that 15 years, it's 8 years. So I guess that's the reasoning behind that. And again, that's my personal view. I think this one is quite controversial, which is the increase of 100% from the previous rate of 15% to 30% of the domiciliation of our abandonment fund. Again, the question is really, for you to be able to claim that deduction, you need to put it in escrow. And it's really, you know, has an impact on the cash flow of companies in the industry, because again, the question is, I'm now taking cash aside, you know, to do this thing. And this is money I could have used, you know, to kind of drive production and exploration. And then also another thing is even transparency of what of those funds, and again, the ability of the banking industry to even take such a huge inflow. Really out of time. Introduction of surcharge on fossil fuels, imposition of 5% surcharge on fossil fuels, and exemption of CNG and renewable energy from the surcharge levy as well. The VAT exemption on gas, as codified in the modification orders and the rest, have been brought in. And mining of coal is now a priority sector, you know, which will then enjoy some level of exemptions and incentives. So really, again, just the last part, very quickly, companies that award contract on it, so tax administration, companies that award contracts to an unregistered person shall be liable to pay an administrative penalty of 5 million naira. I'd say that the change in the name of the FIR to the NRS. Autonomy of state authorities, now state authorities, state internal revenue services will run their affairs independently, and the NRS may support state and local government in joint audits for efficiency. Introduction of the tax ombuds, I think we've talked about that, but you also now need to notify the tax authorities of tax planning arrangements that could provide you with a tax advantage. And deductibility of expenses, companies now deduct expenses wholly and exclusively incurred. So that subjectivity of reasonability and necessity has been taken out. And I think now this kind of gives us a bit more clarity around what deductibility means. So that brings me to the end. 4 minutes over. We might have time for 1 or 2 questions. Perhaps I can take, like I said, I have been handed a question here. And the question is, we have increased activities in the free trade zones, oil and gas free zones, that as an investor based in the zone, based on the tax incentives of NEPSA and GIBSA, what should I respond to the demands of the Nigerian Tax Act? So good question. For me, I'd say there's a transition provision for you. you have a sunset period of about 2 years to kind of then, recalibrate and rethink your business operations. Your model in the past would have been, I have no tax to pay, and that perhaps was your investment decision. Now you'd have to look at things from the perspective of, what is my business philosophy at this point? Am I truly an export-oriented entity? Or if I'm an entity that sells into the customs territory, I then need to start driving some level of efficiency because I am not different from any other company. And whatever decisions I took in the past based off of my tax exempt status, I would have to relook those decisions, whether it's investment decisions, and determine what I would need to do going forward. The second question I've seen here speaks to multinational enterprises and how they should also conduct their businesses in the new era of taxation. I think I've kind of alluded to it. You need to start looking at as an MNE. Now, for instance, if you're a Nigerian MNE, right, you have to start looking at where your strategic decisions are taken. Where do your board meetings hold? Do you now start considering perhaps taking your board meetings out of the country to a close by country like, say, Ghana, or maybe even Benin Republic? You just need to start thinking about those implications so that you don't create an unintended consequence of becoming a Nigerian company under the law. You also need to start looking at things around place of management and control, how that also works for you in terms of your organizational structure and organizational dynamics and how your reporting lines are. Perhaps you need to give a bit more autonomy to your operating entities and the management of those operating entities. You also need to look at your dividend policy and perhaps have a stricter dividend policy of kind of distributing those profits on a yearly basis. And also, start looking at considerations around what your effective tax rate is. In the background, yes.
Thank you, Chijioke.
Absolutely.
I have 3 questions here from you from the chat box, right? So we'll just go over them very quickly. So I think the first one is around the indirect transfer of shares that have just been introduced by the Nigerian Tax Act, right? And Shola Okeowo is asking, right, how can the indirect transfer of shares be tracked for CGT purposes? Right? If these things happen offshore, how can even the tax authorities in Nigeria know that the change of ownership have happened miles or countries away?
Okay, I think a couple of things. One would be things around exchange of information. I think there's a huge focus on exchange of information across board. Other things would also be, you'd also start considering things like, are there any requirements in Nigeria if there's some kind of change of ownership? Are you expected to file something, with the Nigerian authorities? So again, the different things would kind of come into play with regards to how these things would play out, right? But I'd say it's primarily driven by exchange of information and if there are any requirements to update your ownership structure.
Thank you, Chijioke. The next one is on VAT. With the reforms that have come through on the VAT Act, in terms of input VAT that has now been expanded to fixed assets and services. Now, the question here is, given the oil and gas industry and the obligation to deduct VAT at source, what happens to companies where their output VAT has been deducted at source under this new law?
Yeah, I think I kind of answered that question in terms of the fact that you then have an opportunity to claim a refund. And, if that refund hasn't been provided, I believe within 30 days, you then have an ability to offset that from other taxes as well. So I think this creates the right environment for us to actually then be able to manage the cash flow of companies where you're able to then, just either claim a refund or offset it against other taxes. Perhaps the third version is if I don't have other taxes and you haven't given me a refund, can I sell my credit? But again, that is perhaps something that will come in another iteration of the act. I think we've really gone way past our time. Like I've said, we will provide additional responses to your questions. So please keep the questions coming. We will send you written responses. I will now hand over to, in terms of how we can support you, I think let me quickly run through this before I hand over to Babatunde. You need to take action. So what should you do? Awareness, sensitize your management and empower your people. There's a lot of change management that has to happen across all the parts of the business, whether it's your supply chain folks, your legal folks, finance folks, procurement folks, the commercial folks. Everybody needs to understand. Back in my former life, I used to have breakfast sessions for all the end functions in the business, just to help them understand the issues, with the tax laws and how it affects, their different operations and different KPIs as well. So we need to create awareness, sensitize management, empower our people in terms of training them. We need to do a detailed and holistic impact assessment on the business and also our beneficial owners. We need to reframe our tax strategy, setting an opportunity pool, and also start updating our risk register. Operationalization and implementation. Look, there are so many small changes in this law, and you need to actually start asking yourself, my tax governance function, my tax management function, and the framework and the technology I use, how robust is it to help proper implementation? You need to communicate and engage with key stakeholders, your shareholders, your employees, tax authorities, host communities on the implications of the law, and just stay updated and ensure that you manage the change properly. From a PwC standpoint, we can facilitate workshops and awareness programs for you, and we can prepare a holistic impact assessment with a clear action plan for your business, and we can deliver a good tax strategy, opportunity pool for your business and your risk register, and also do a backward look at what you've kind of committed to so far and implications for you, especially when you're looking at exit strategies. Tax governance and management function optimization and efficient technology adoption, preparing total tax contribution reports, tax filing requests, financial reporting and disclosures, and also support you with change management and providing continuous insights on key developments. I think it's also important that we must understand that we have a tax tool that we will be launching as well, which is it's essentially a tool that will help you through your implementation and transformation journey. So please watch this space for the PwC tax transformation tool that I believe will be launched next Monday. They're going to use. Okay, so I'm going to hand over to Babatunde to actually walk us through the next phase of this, which is our upcoming training. So over to you, Babatunde.
Yes, thank you very much, Chijioke, for the presentations, for also taking the questions and telling our participants the next actions, right, following the new change. Right, and one of those actions is pretty much to be aware, increase your knowledge of the new laws, right? So to this end, we have 2 well-packaged trainings for our participants. The first is themed from policy to practice, right? So there's a lot of changes that are driven by policies that Chijioke had presented earlier, right? These trainings are going to be starting by next week, right? It will run its course between July and August, right? We have sessions that speak to the main changes, key changes around the fiscal space, what lives, what dies, right? We also have deep dive sessions into key areas of the tax laws in terms of e-invoicing that a lot of them asked about. Also how trainings around the free trade zone as well. We see questions here, right, around that. And we have those sessions. So please register for the sessions you'll be interested in, right? We'll be happy to have a conversation and take a deeper look into what these provisions of the law means to you and your business, right? Over the next few months as well, we'll be focusing on the new laws and its impact on trade, including global trade as well. Right, we know what is going on with the AfCFTA and also with the actions of the US government and its impact on supply chains and also flow of goods, right? So we'll be anchoring a reframing tax, navigating Nigeria's tax reforms amid global trade developments. This is our second cohort. We had our first last year in Rwanda, right? So this is our second cohort. We'll be happy to have you to talk about this a bit more and learn together as one unit. That's all from me.
Okay, thanks, Babatunde. So again, here, this is my colleagues, my partner colleagues, who you can also reach out to. Many of you know them. Kenneth Irukume, who leads Tax Reporting and Strategy Group. Uwaegbute, who leads People and Organization Group and International Tax Services as well. And is the Africa Family Business Leader Group. Esimi, please forgive me, I always get it wrong. But when it comes to the private wealth, she actually leads that for us in Africa. Shehu Adu is transfer pricing partner and head of transfer pricing. Tiwa is a transfer pricing partner as well, and also drives a lot of what we do from a corporate tax consulting standpoint. Tim Siloma, expatriate in Nigeria, is a Kenyan and who is a partner, and he drives our tax technology. And we have a few resources. We have the Nigeria Tax Reforms Act, the top 20 changes you need to know and the top 6 things to do. You just please go to the link and download those resources. We will be launching our deep dive for our Insight series. We will be launching it on Monday. So please watch this space for the PwC Insight series. It's actually the industry leader when it comes to insights on new laws. So that will be launched on Monday. And also our tax transformation tool, which is really a technology-based tool that will help you, give you a baseline of where you are in terms of this tax transformation journey, and also takes you on a journey of where you need to be. So we will be launching that on Monday as well. Tunde has talked about the trainings as well. So please engage with the training, and reach out to the people that are on this that you've seen here and any of your PwC contacts as well. We will send you the responses to all your questions, and we will also create some kind of shared site where you can see the key issues that were communicated in all the Insights webinars that have happened. The way the slides are presented, some of you are asking for the slides, but the way the slides are presented may not give you the real information you need. That information, you will get it from the Insight series. Trust me on that. So thank you very much and enjoy the rest of your day. It has been an absolute pleasure interacting with all of you. I wish I had more time, and perhaps in subsequent versions of this, we might have to create additional time for this. Thank you and enjoy the rest of your day.